But we have been at record highs. Notable today, the 10-year yield near the lowest level since April. So we're watching all that with the Fed meeting on tap. Will they go 25 or will they go 50? That seems to be the biggest question because the market is convinced nearly 100% you're going to get at least 25. So Weiss, the question is, what do stocks do? That's question number one for today. JP Morgan's trading desk says this could become a sell the news event. I've heard that from others as well, because the market has continued to ramp up, today notwithstanding, ahead of that meeting. What do you think?
So I think there's a real possibility, but it's not going to turn the rate cut. If we get 50, the market takes off. 25 is a base case. I think that, and what JP Morgan's saying is that that's in the market right now. I agree with that. However, it's going to turn on what the narrative is.
That's right. Powell's words. Powell's words more than the numbers are probably what matter more than anything right now.
Right. And look, it's clear from the numbers that jobs are going away. Claims are high. Job growth is low. It's basically flat. So they're going to decide what is going to move the most. Is it going to be inflation continuing to spike up? And then they have an out. That's tariffs. It's a one-time event. So I actually think they're going to be somewhat dovish, when they go next week.
Okay, how about a dovish 25 cut? That great for the market?
I think it goes up. I think it goes up.
Yeah, Bryn, what about you? How do you game this out?
I think we get a 25 basis point rate cut. 50 doesn't seem to be necessary. I think we get a 25 basis point rate cut. They acknowledge the weakness in the jobs market. I think he's definitely going to get questions about the data itself, right? The 911,000 revisions we have. So I'm really going to be curious to hear how they thread that needle. I think that the market, once again, is a pull-forward mechanism. So we already have this priced in. I don't think we're just going to get some rip-roaring rally. I think what's been working will continue to work. And so I think you're going to have sectors like real estate, private equity, et cetera, that will continue to be these beneficiaries of a lower rate environment. And I don't think we are going to be one and done.
I've heard, Rob, for, I don't know, like 2 weeks that it's priced in. How could it be priced in if the markets continue to set new highs? Maybe it's not priced in.
Well, there's a little bit of positioning there, too. If you look at institutional investor positioning, we're in the 58th percentile, which Deutsche Bank would define as decidedly neutral. So I agree with Steve. I think it depends on the communication that comes out with it. But it's also what the data informs from here. So short run, you might get a move. But then what does the data inform from here? And I think if the data doesn't lean towards a direction of further cuts, not a disaster where you're seeing growth that completely roll over, but just leans towards the ability to have further cuts, given the moves in stocks, given the move in specifically small caps, treasuries, gold, you could see a re-rating that's maybe more substantial. I just don't think so, because as we go into the fourth quarter, I think you're going to see a pretty big positioning chase from here. It's more next year.
Okay, that's what I want to get into. That tees it up perfectly. Like the best rate cut, right? We think we're going to get a cut, 25, 50, whatever. Your best positioning for a cut. Do you stay big or do you go small? Russell 2000 is on pace for its 6th straight week of gains. Small caps are having their best quarter since the end of 2023. The Nasdaq's up 14% year to date, and the AI trade, as you know, has been back on lately. Stay big or go small post rate cut between now and the end of the year. What do you do?
Well, I always stay big, so I'm a little bit less objective than some of our friends here.
Okay, well, what do our friendly viewers? What should they do?
Follow me and stay big, because the challenge is moving forward, to Steve's point, if the data breaks down, then you're going to see the small cap, the more speculative side roll over.
Even with rate cuts, if the data breaks down?
I think so, because you're betting on a stronger economy. So here's the thing about the sell the news, because I thought that was a really interesting note. If we get a 50 basis point rate cut, I think that would be a sell the news event, only because from my perspective, it could be a little bit scary. Like, why do they need to do that? I'd rather see it be more of a cool glide. Like, give me 25 now and a few more 25s. 50 may spook the market.
Man, I don't know.
It would spook the market very short term. Very short term.
Consumer sentiment came out negative today.
Yeah, but I still think 50 takes it higher. Whatever the knee-jerk reaction is, it's so tough to account for. Usually it's a head fake.
How would you answer that question? Stay big or go small? We're thinking about outperformance now, right? Not what we like, this, that, and the other.
Yeah.
Outperformance between post-cut and end of the year.
Look, I would stay big because I think it'll continue to work. And if you take a long-term approach rather than trying to buy the smaller caps here, the smaller caps, they're going to be hit a lot harder by a slowing economy. And that's what we're seeing.
But why then is the Russell up 5% over the last month if the data has been showing that the economy and the job market is slowing? Well, wouldn't that be one of the leading indicators in the market that agrees with the data?
Well, these are new markets. So generally, yes, but generally the small cap starts moving, and some of the junk, I'm not saying small caps junk, but we've seen that move also, and that typically moves. They're the last ones to move. So as you look for what's not participating in the rally over the last few years, it's small cap. We've had some head fakes on small cap, so it's a catch-up trade.
Well, you just said small caps are the last ones to move. We both know that generally speaking, small caps are the first ones to go in and the first ones to come out.
Go out, right.
So, but they're not the first ones to go in because they're not going in. They're up 5% over the last month, even in the face of data that's been a little squirrely and job numbers that just flat out haven't been good. Right?
Understood. My point is the dynamics. Let me just finish the thought.
Yeah, go ahead.
But the dynamics in this market, unlike any other cycle. They just are, because everything that's in index funds, because retail investors aren't really selling much on news. Some are, and creating those bottoms. But overall, people are adding to it. We really haven't seen that, while we've all been in the business. So over the last few years, it's changed. So that's what's affecting small caps.
Well, to your point then, so maybe there's full positioning towards the mega caps. And if it's 50, people say, well, I mean, there's going to be a huge bang for your buck in other places of the market finally, and then you get a rotation.
Why would that happen? Because for 3 years, there's been very little in the way of refis for these small caps. They're dependent upon capital markets. Large caps aren't. So
yeah, right. Rates going down and capital markets already picking up is good.
And I think that the small cap that's going to go out and refi that needs money, the cheaper money is better for the small cap. So we've seen it. Whether that trade
We've already seen it. Rates haven't even barely budged.
We've seen the move in the small caps.
It depends on the follow-through from an economic standpoint, period, with small caps. If you get follow-through, which means that you're cutting in a benign scenario, small caps will continue to run. They will continue to do well.
Aren't you kind of doing that now? Aren't you kind of cutting in a reasonably benign scenario?
Yes, but
you're still hanging in there.
But that's why I talked about that intermediate thing, Scott. If the labor market continues to break down and the consumer fundamentals get worse, that indicates further economic deceleration. And I think small caps have a tough time with that scenario. So I think we're waiting for data right now to confirm the pace of the slowdown. How dramatic is it going to be? We personally don't think there's going to be a recession, but small caps have run so much here recently that I think the safe playbook is what these guys are talking about, because remember, the highest quality parts of the index are being driven by AI, data center demand that is still robust. You saw it through Oracle. All those trends are very powerful in place.
That's fair.
And this is speculation as to whether we are going to be able to get that economic acceleration with rate cuts.
That's fair.
And you're going to be able to perfectly engineer that handoff of the baton from the one to the other.